Okay, welcome everybody to the Stockyards Bank Bright Ideas WebEx series. My name is Jason Hamilton, been your host of this for the last 18 months. If you've been with us in the past, welcome back. If this is your first time, we welcome you. Glad you're able to hop on. Got a little smaller crowd today than normal, which maybe makes this a little bit more personal, hopefully. Hope everyone's having a great week. I probably picked a little bit of a bad week even going into Labor Day weekend. I'm sure vacation schedules, things like that are interfering, but I wanted to get this in before September got to us. So here we are, another WebEx. We've had 18 months of WebExes. I think people are getting tired of them. I hope one day soon we'll be able to have an economic seminar hosted somewhere down at one of our locations where we've done it in the past, where we're able to invite everybody out and do this in person. But for now, we'll keep it to a WebEx. I'm going to cover some things here, kind of high level. I wanted to keep it a little bit more engaging, not too far into the weeds, and allow for everyone just to kind of understand where we are with the markets, where we've been headed, and just a few other interesting things. So I manage our financial planning group. I'm an investment advisor also. I'm actually housed out of Cincinnati. And I put this presentation together kind of following the Little League World Series. So I kind of named it the 7th inning stretch. And, we're about 3/4 of the way through the year. So I was looking for some title of what to call this. And then off to the side, if you've been on this call before, I've joked about my crystal ball that I've ordered from Amazon. Hoping to be able to predict the future. It's yet to come, but this is what it would look like, I guess. And want to cover kind of a general market update. And through that, as I'm updating you on the market, I have rates of retirement, which is an interesting topic that I kind of read about, wanted to kind of address with everyone. And then home prices literally raising through the roof. All those things will have some perspective of the COVID pandemic kind of baked into it. So with that, I'll get started here, kind of talk about the current market, where we've been, what's happening, and despite COVID and its vengeance of when it seems like it's going away and the Delta variant comes back upon us and has us maybe startled or cautious. I don't think we'll see a shutdown, nothing as extreme as what we saw last year, but it has people on edge again. It's talked about, like it has been for the last 18 months. COVID's in the news every day for different reasons. But regardless, the market's been extremely resilient. So let me just preface this before I even get to this year's market numbers. We came off of 2019, S&P 500 was up about 32% with dividends. 2020, at one point, the market's down 35%. We finished the year, the S&P 500 up 18% through what was many people thinking at one point last year, just the end of any good returns. And then this year, we continue to move forward, charge along, and the S&P 500 is up about 21%. And if we go back over a one-year period, we're up 31% on a one-year period, which I find very astonishing still, just given what we've gone through, the market returns we've already seen. And there's reasons for that, obviously. The Fed's been very accommodative. We've had trillions of dollars of stimulus money pumped in, and we've essentially propped up the stock market with those maneuvers. The Fed is not willing to let the market collapse, which is a good thing for the short term. It's the question of the long term, how does that play out? And I'll talk about that a little bit more down the road. But even given current environment, uptick in COVID, we're charging along. Now, what we did see, what was a change over the last couple of years versus this year, and it ended kind of in 2020, carried into this year, is value stocks led the way. We moved away from technology dominating the market to a value-led stock market, and it actually became a very broad stock market rally. It wasn't, last year's return for the most part came out of, maybe a dozen names that really led the market's returns, most of those technology names. This year it's become much more broader, which is good to see. But and I'll show you this in another slide as we look at style class returns. Value may not be leading the way for much longer. Growth has had a tremendous run here over the summer, over the last 3 months, call it. It's caught up in the large cap to value, and that's just telling us that that's just how much volatility there is in the market. The market doesn't really know where it wants to go, and some of that's been interest rate led, inflation fears. And even more reason why you should have a diversified portfolio and not necessarily just rely on value names or just growth names. So with that said, looking back over the last quarter, the second quarter earnings were historical. We had tremendous year-over-year growth. It was a record level. The companies reporting their earnings beats was at a record number. And all of that came surprisingly with a muted stock market reaction. We didn't see a huge pop off of the second quarter earnings releases. The market kind of had already rallied and gotten there. We'd have to say that it was pretty much priced into the market. It was expecting there to be a very strong second quarter. Reason being, if you look back year over year, second quarter last year was horrendous. We were pretty much in a complete shutdown. So profits were very low, earnings were lower, and there was really nowhere else to go but up. And we had a tremendous quarter resulting in that because of all that. Third quarter, fourth quarter, we don't expect that growth to be anywhere near that, but we're expecting very strong earnings growth to get us through the year. It will start to slow down because we're catching back up to where we were year over year last year when the economy had started opening back up. So the earnings beats shouldn't be as dramatic. One thing for sure is because of all of this, of the market rally, the strength in the stock performances, is valuations do continue to be pretty stretched. We're pretty far out there on valuations. Is it horrendous or at a point where the market can't continue to go up? Absolutely not, but it is something to keep an eye on. With that, because of valuations being where they are, we would fully expect that the volatility in the stock market will continue. When you have stretched valuations, you tend to have a very volatile stock market, and we've already had one most of this year. We've had a number of kind of ups and downs, and right when we think the down's going to maybe be more significant, the market's found its feet and bounced back pretty well and continues to move up. So with that, what I wanted to kind of show you is, well, this slide will advance here, is, you know, where have the market's returns come from? So you can see this chart here, which might look small on your screen, goes back to 2007, and then shows us year to date. So year to date, where we've seen a lot of the stock market performance come from is energy. Energy's led the way, up 45% for the year so far. Energy is a name that actually doesn't very often lead the way. If you look back over the last 13 years here, almost 14 years, it's only been a leader 2 other times, and usually it's bottom of the list, somewhere towards the bottom in performance. You know, just being a commodity, it has not led the way. Financials have done very well this year too, and I'd have to say finally. They have not done well with a very low interest rate environment for some time. Now, you can see over the last couple of years, because we've seen interest rates bouncing up, bouncing down, bouncing up, financials have done a little bit better. But, you know, they haven't been at the top very much coming out of the the financial crisis, 13 years ago. And then you can see the other ones: real estate, telecommunications, industrials. The S&P 500 is kind of the middle of the road. And if I was looking at this, it's almost like ironically, it's almost like your diversified portfolio, which it really is, being the S&P 500, but it's kind of steady Eddie right in the middle, all the white bars, all the white squares being those performance years. And then you've got materials, information technology, healthcare, consumer discretionaries, consumer staples, and then utilities kind of rounding off the bottom. And discretionary, you know, being lower this year, as you can see, looking at the past, it's actually one of the top performers year over year. This year, it's kind of have a little bit of an off year, and healthcare kind of the same. Usually does fairly well year over year, but a little bit more poor in the performance relative to the S&P 500, still having a great performance year. Reason why, and I mentioned there was volatility, and we've seen some ups and downs in the market. And if you go back, it's probably been 2 months now, we had a Monday that inflation was kind of fearful. We were worried about inflation on top of the Delta variant. News kind of hit the market pretty hard, and we had a pretty hard sell-off. I think it was about a 1,000-point sell-off on the Dow that day, or a little bit over. And it was kind of ugly. It had some investors probably pretty scared. But the market quickly rebounded the following day, and then I think for 3 days we had 3 strong market return days, and we wiped out that one really bad day. And a lot of that could be said to be because there's so much cash on the sidelines. Here you can see from 2000 up through June of 2021, this is just balances of money markets along the way. And coming into, we were historically low for quite some time, and then we had the financial crisis in 08, 09. It brought savings levels up a little bit higher, and then that fell off as individuals went out and they started spending. Obviously, it drove the economy. And then we came into early 2020. A lot of fear out there with the pandemic. What was it going to look like? It was very scary, and we saw savings rates hit basically all-time highs. And they remain at a very high level. A lot of that's just because individuals have been more prudent with their savings habits, but also there's been a lot of stimulus pumped into families from the government also. We've had the Child Credit Act that you're getting advanced rather than claiming on your tax return next year. Some families are qualifying and they're paying out that out monthly. There's been several stimulus payments that have been made to qualifying families. And in many cases, sometimes that money's been saved. It has gone to a lot of families that you would say don't need the money. Both husband and wife are still working, or maybe one of the spouses is working and has always been the household income earner, and they haven't seen a whole lot change in their lifestyle, so they save that money, and therefore we've seen these patterns move up. But because of that, that's probably a lot of what's helping drive the market. When there's dips out there, there's a lot of investors that feel like they've missed the tremendous growth in the market, and they're buying on those dips. And with as much money being pumped in stimulus-wise, also it's propping up the market, keeping it very strong. Don't expect to see anything change too dramatically moving forward. Let me just leave these off here, maybe. All right, well. We expect the year to kind of finish off, pretty steady of what we've seen. Fourth quarter generally is a very strong market return historically. Will that continue? Not quite sure. A lot of it will fall upon in consumer sentiment. How strong do they feel about the markets? Will they go out and spend at the retail levels? These days, shop online, as we've seen Amazon greatly be rewarded because of the new pattern and way of shopping. Not that it wasn't already there, but it's been greatly reinforced because of COVID. But where we've seen returns come from as far as a style class, so earlier I showed you the sectors and how each sector was performing thus far this year. I want to kind of show you style classes, value versus growth, large cap versus small cap, where the returns come from. And I referenced earlier, value has led the way quite dramatically, and some would say finally for a change, because for the last 5 years, value was kind of not existent relative to the growth market out there. So if I'm looking at the right-hand side first, year to date, value's up almost 21%, growth is up, large cap about 20%. If we went back, let's say 3 months ago, value was up about 18.5%, and growth was only up about 6%. So there was a very wide dispersion between our value in large cap and growth. And as you can see here, growth has really rallied over the summer here. Rates fell back down. In March, we saw the 10-year Treasury really bounce up hard. Inflation was a fear. It scared growth investors. Therefore, there's a lot of value purchasing of stocks. And now that that fear has subsided a little bit, we've seen growth really start to perform and catch up. Will it actually take over and flip-flop? You know, not quite sure. The way it's looking right now, yes, I would argue that it's going to. Rates stay fairly low. And then you can see mid-cap, small-cap. Mid-cap's a little bit more consistent, and then small-cap still, the small-cap value is still greatly, on a year-to-date performance, greatly outperforming growth. But if you come back over to the left side in these boxes, this is a 1 week. So this is last week. How did the market perform last week? On a 1 week period, we did see growth slightly outperform value in large cap. Down in the small cap, you know, we were greatly underperforming year to date for small cap growth, but on a 1 week period, small cap growth has done better than small cap value. We'll continue to watch this. Again, this is just more emphasis of why diversified portfolios make sense, why asset allocation makes sense, why you don't necessarily want to get too cute and really only overweight maybe just here in growth or value. You kind of want to, if I was drawing a circle here, I'd want to kind of round off and catch a little bit of each of these style boxes and build a portfolio that way. And really your returns on an annual basis, it's not necessarily because I picked all the right stocks, I picked all the right funds. It's really 90-some% of your return comes from asset allocation. And we have to remember that when we're building portfolios. So now that we've kind of talked about where performance has come from, where we think it's going, let's talk about some other things that were hot topics through especially the early part of the year, and really coming to a head in March when we saw the 10-year Treasury bounce really hard off of a low and went up to almost 1.8%, which was as low as that sounds, that was a pretty tremendous high base of where we had been trading on the 10-year Treasuries. So the question becomes, is inflation transitory? And that's something, if you've been watching any of the news or reading any articles, it's been talked about quite a bit. The Fed believes it is. We believe it is. It looks like it is transitory. And what I mean by that transitory is that it's going to be short-lived. As we review where we were a year ago, just like as we were looking at the corporate earnings and how they had strong performance year over year because we were the tremendous lag of growth last year, inflation's kind of the same way. Economy was shut down last year. Things were kind of cheap because people weren't buying things. You could find sales. As the economy started to open back up, those things went away. Supply chain quickly dried up. It's still an issue. And we saw inflation this summer reported at the highest levels that we've seen in a long time, a little bit higher than what was even expected. But it's even starting to kind of trend down a little bit. And we believe it'll continue to trend down through this year and into next year and get back to a more normal level. Now, remind you, coming into the whole COVID pandemic, inflation was at a historical low. We were actually below 2% for the last 10 years on an annualized. It was well below 2%. The Fed's goal is, in its policy, it wants to see inflation kind of be at a mean of about 2%. And for us to get to 2%, they're going to let inflation have periods of times where it's going to be 3.5%, maybe even 4%. We saw it at upwards of 6% this year, so on a couple monthly reports. And it's going to let that happen because we want to bring the 2% up. And then it'll continue to probably play itself out and become a little bit more rational. No reason right now to think that that's not going to be the way it plays out. Could something happen tomorrow that changes that? Absolutely. Looking longer term, yes, I think inflation probably at some point has to become a little bit more of an emphasis. There probably will be more inflation fears because we've simply pumped so much money into the economy. We've taken on so much debt. Most countries have taken on tremendous debt to try to get through COVID. They've been pumping in exorbitant amounts of money to keep their economies alive. That will at some point catch up. But the question will become, do rates follow? When do they follow? How high do they go? And that's a highly debated topic, and it largely comes back to the debt level. So here, for instance, headwinds. Why might inflation not really take off like one would think? If you're a history buff or you were an economic major and you're thinking, gosh, there's no reason why we wouldn't have hyperinflation. Where's the logic of why it wouldn't happen? There are some headwinds in that, and it's debt levels. We've taken on such a tremendous amount of debt that debt service to pay that interest that we're on the level of debt is a tremendous amount of our GDP every year. So they're going to be delicate likely about how they raise rates because we can't necessarily afford to pay our debt service back at a really high rate. How they'll manage that is going to be interesting to see. It'll be delicate, but a lot of other countries are going to be in the same boat. And then something you don't hear talked about also a lot is population growth. Our population growth has been slowing quite a bit over the last 10, 15, 20 years. A lot of that is because just professional lifestyles, careers. Some couples have come together later in life. They've decided not to have kids, or they're having fewer kids because they got married later and they're not having 2 and 3 kids. Maybe they're just having 1 or 2. That's actually a deflationary sign for the future. There's just less money being spent back into the economy. Kids cost a lot of money. We spend, I've got 2. I feel like we spend a tremendous amount of money on them, feeding them. The last 18 months, my Kroger bill's never been so big, as we restock groceries every week. But those are probably some headwinds that we think will kind of keep inflation and rates a little bit more tame, but to be determined. Today's news, what I'm telling you, could be obsolete tomorrow. But from the best of our knowledge, what we're seeing, that's kind of where we think. We've heard a lot of talk about when does the Fed step in and decide to raise rates, and there's a process. We still think we're a little bit a ways away from actually seeing a rate increase. And right now, the Fed, each month, they buy about $120 billion worth of bonds. That's their way of trying to get money into the market. But the process is step one is they're going to signal a taper of that bond buying. So that's the first announcement that would come, that they'll announce it'll be a reduction. They're going to taper the bond buying activities, whatever it might be. Then at some point following that, several months probably, they'll begin the tapering process. And that'll last for a little bit of a period, maybe a quarter, 2 quarters, just depends. And then from that point on, there'll probably be a lapse in time, maybe a couple months, and then they're going to end the tapering altogether. So they would completely stop their bond buying. And this would mean that they're strengthening the economy. So first, we have to get to where they feel like the economy is strong enough to sustain itself. And then once they do that, and we get through that period of time, not long after, probably see the first signal of a rate hike. And not long after that signal, there would be a rate hike. Expectations are we wouldn't see rates go skyrocketing very quickly. It would be pretty soft increases over kind of a lengthy period of time, probably over a 1-year period, 18-month period. And that's something, earlier I didn't really touch on a whole lot is the economy and the stock market, they really are two moving targets out there, 2 pieces. The stock market is well ahead of the economy. And if you look at the stock market, you would think, oh, our economy is booming. It's doing incredible. And while it has over the last year, because we're looking at a year-over-year basis, GDP growth was strong. If I go back and I average out the last couple of years, we still have a very slow and steady economy. It has a long way to go before it actually could catch up to the stock market. One could argue that at some point, how far ahead can the stock market get? Is it going to come back to the overall economy at some point, or is the economy going to catch up to some degree? And not that they have to, but there's a pretty wide dispersion right now on where those 2 moving targets are. Now, largely, the stock market tracks corporate earnings. And as I told you a few slides ago, corporate earnings have been tremendously strong. There's no sign of them weakening greatly enough that we think it would impact the stock market. So if I had historical chart here of corporate earnings and the stock market, you would see that it almost always traces over one another. There have been deviations from it, but they track very closely. So corporate earnings in the stock market actually tracks much closer in correlation than the economy ever would with the stock market. But at some point, we have to be somewhat logical and rational, at least from my perception, and I think they have to come a little bit closer together to have a healthy economy and stock market. So let's move on and talk about something that, as I was kind of just reading through some things over the last couple of weeks, it kind of caught my eye. I didn't quite realize a few of these things as greatly as they were out there and being talked about or on the news. So U.S. retirement rates, somewhere between 1.5 and 2.5 million Americans actually retired since COVID started. And this is substantially higher than the historical pace. And this is also weighing on kind of the market and the economic recovery. So if you've gone out to a restaurant or if you've just tried to go to any business that maybe you visited a lot in the past, you know, service is a little different. Not for all companies, but for a lot, especially at the hospitality and the restaurants. You know, they're running short-staffed, and there's been a lot of retirees out there. Now, and a lot of the service industry generally does have younger individuals working there, but when you compact that to our older Americans kind of coming out of the workforce, it's been a double whammy. The labor force, surprisingly, for those 65 and over, had been rising, and it was at first I was kind of surprised by that a little bit, but because of technology, a lot of us have jobs that allow us to work at home now, or we're on a computer. They're not labor intensive so much anymore. Even those in manufacturing, there's a lot of robotics. The assembly lines become much more automated. The physical capacity for someone working in that job is not as strenuous as it has been in the past. So those that were in their 60s, a lot of our baby boomers, they were working longer than normal. 1 in 5, in fact, in that age group were working or actively seeking some type of employment during that period of time. But COVID changed their mind. A lot of it was based off of health. They didn't want to risk their health to being in an environment where they felt like they could contract COVID and become, you know, sick, ill enough that they would pass away from it or have a side effect from it. So they left the labor force. Now we are seeing, as things have started to get better until this Delta variant, but I think this too will pass. We're going to see those baby boomers, those 65 and older, that age class probably come back to work. And the big reason is a lot of them can't afford to stay retired. So when they left the workforce last year, or maybe early this year, it was a big gray market if they could even do it. Yes, the numbers might have looked okay, or they were really questionable, but they just didn't feel like the risk of their health was worth it, so they left. But they're finding that they actually hadn't saved enough money to feel like they can comfortably stay retired. So they want to get back to the workforce. And with approximately 10 million open positions in the U.S. economy, wages are rising. We expect there are going to be a number of workers that will come out of retirement and fill some of that void once they feel comfortable with where COVID, the Delta variant is, and where it's going to be moving forward. You know, more to be said about this. You know, it's still tough to get employees out of the house and back to work. A lot of that's because I would have to say the fault of our own government with some of the stimulus that was given out there. Like I said, a lot of families that didn't need stimulus were receiving stimulus. Others, you know, they're receiving a pretty nice perk. Naturally so, I get it. Raising a household is expensive, but we're giving such a perk that wages are lower than what that staying-at-home perk is, and somehow that'll have to get fixed without hurting the small business owner or the other businesses. I realize they'll pass through some of that, but more to come, and we'll continue to watch that closely. Another hot topic, and many of you probably have noticed this with a neighbor maybe selling their house recently, or if you're just watching the real estate market, home prices are literally through the roof. We were in a short recession with COVID last year. It was short and sweet. We went into it and came out of it almost in a blink of an eye. But, generally a recession leads to a little bit of a housing crash. Maybe that's too harsh of a word, but a pullback in housing. This current crisis that we're in defied that pattern. We did not see anything like that. In fact, it actually shot the housing market up. Prices have moved the complete opposite direction of the economy, and there are some very logical reasons why that's happened. Dwelling values across almost all major economies, they've trended higher. So on average, across all the major economies, they're up 9.4 in the first quarter of this year, the fastest growth in 3 decades. The U.S., Canada, and I forget who the third country was, they're leading the way. They're actually well into the double digits in first quarter growth for housing prices. It is slowing a little bit. As I talk to our mortgage group about things, just my own clients, you couldn't go out. It was hard to buy, especially a second property. Maybe it was an investment property. If you weren't paying cash and you weren't willing to pay over asking price, you probably weren't going to get that property. You had to have pretty strong means to be able to go out and capture some of these homes that were going up for sale. And here in Cincinnati, in the area I live, my daily habit, for whatever reason, is first thing I do when I get on the computer is I look at the Client. I like to see, hey, what's happening real estate-wise in Cincinnati? What's popped back up? What are the recent ads? How fast are homes selling? Homes were selling literally in a matter of days. And when we had a neighbor's house go up for sale, sold instantly. I know of individuals that sold their homes, had 10, 12, 15 offers all over asking price. And a lot of that's being boosted because of our loose policy. Interest rates are extremely low. I showed you that slide very early on of our savings rates amongst consumers. Savings rates have been very high also. Because of that, they've had plenty of money for down payments to go out and buy homes, whatever they're doing. So that has greatly boosted the home or the real estate market. Another demand that's come out of COVID, which is probably the biggest contributing factor of, why are homes being so highly sought after, is we had pre-COVID, millennials didn't want to own a house. They wanted to own maybe a townhome, an apartment, a luxury apartment, something like that. They are not ones that like to maintain properties. That was just kind of their stereotype. And then COVID hit, and they thought, gosh, I'm spending so much of time at home now, and I don't like the size of my space. They started buying homes at a pretty rapid pace because they wanted more room. They were working out of their home office now, which for a lot of them is becoming more permanent than it is temporary. So that also helped boost home values as those were out searching for homes, and supply was pretty low. Obviously, another contributing factor is the demand was much higher than supply, so home values greatly shot up. Given all this, if you've experienced this firsthand, you've just been hearing about the stories of how crazy the real estate market is, we are still below the levels that we saw coming into the financial crisis in 2008. So those in 05, 06, 07, housing market was gangbusters. You could have gotten a loan and you didn't have to even prove income, and we were an all-time high then. We're actually not anywhere near that level, surprisingly. I was surprised to see that and hear that and read that. Continue to see how this plays out. Like I said, from what we're seeing, it's kind of slowed down. I think people have gotten some sense in, okay, well, if I'm going to sell my home and capitalize and take my profits, where am I going to go? I'm probably going to have to spend more to get a similar home to move somewhere else. And with just how crazy the prices have gotten, people have found some logic. They've become a little bit more rational, and they're not making what we're seeing, the same hasty decisions. So with that said, a few interesting data points that I've kind of drummed up, and don't hold me to the exact, and it's not exactly 10 years, I just kind of picked a day randomly in the month. 10 years ago, the S&P 500 was at about 1,100. We're over 4,000 today. The Dow was just shy of 11,000. Today we're at almost 36,000. The 10-year Treasury was at 1.87, a little bit higher than we are today. We were close to that earlier this year. Tesla, everyone likes to talk about the EV stocks and some of the really fast-growing growth names out there. Tesla was trading at $5.71. It was kind of a no-name out there 10 years ago, and now it's trading at about $725 a share. And this is with any splits included. Apple was at it was at a bargain at $14.46, just like Tesla. It was at $5.71. Apple's now at about $150. Again, that's split adjusted. Procter & Gamble, because I'm in Cincinnati, it's a well-known consumer staples company. Just history of doing very well. Was at $66.71. It's at about $145 today. So things have come a long way. COVID didn't exist. We weren't even worried about pandemics really back then. And then I didn't put it in here because it's a little bit more of a side conversation, but another thing that everyone wants to talk about when I'm at a client meeting is Bitcoin. So Bitcoin was new. October 2010, Bitcoin was still fairly new. Investors were intrigued by it. They were throwing, $100 at it, $500 at it, hoping that it was a home run. And many of them actually lost track of their investment. But a $100 investment in October 2010 into Bitcoin, I think it was trading at 10 cents a share or something like that. Then at the high earlier this year when Bitcoin hit 60,000, you would have had $48 million off of that investment. The irony of what I was referencing earlier is that there were a lot of people that put $100 there, $50 there, $500 there, and they lost track of their password to get into their digital account. They lost their hard drive, however they stored it, and approximately of all the Bitcoin value out there, about 30% of it is lost. They think it will never be found. But I just thought it'd be interesting to kind of highlight some data points and things that have happened out there over the last 10 years, things to make you smile. At the end of the day, kind of what I've talked through here, I think it just puts an emphasis on why diversified portfolios make sense, why getting cute in the stock market might not make sense. Yes, on short periods of time, you could have hit home runs and done fairly well. Over long periods of time, a diversified, disciplined portfolio does very well. And there's a lot of volatility out there right now. The markets are at all-time highs. There's a lot of concern out there. The only thing I can tell you, and what we tell our clients, is that time in the market is more valuable than time out of the market. You're almost always rewarded for staying invested in a disciplined portfolio. Not saying that you can't make changes, but drastic changes actually detract a lot of value. And we've had clients along the way that have gotten things right. Maybe pre-COVID, they were feeling really unsure about things, and they really wanted to raise a lot of cash. And we did that, and they looked like heroes. But I can tell you, none of them have gotten back into the market, or if they did, they lost tremendous amounts of value because they waited so long to get back into the market. So you're not going to time both sides of an event very well. And I referenced earlier, asset allocation is where 90-some% of your performance comes from. We hope as you're reading through the news, watching the news, reading articles, listening to us, that you truly understand how important a diversified portfolio is. With that said, I want to allow for any questions. You can, I think *6 will unmute yourself. You can chat me a question if you have a question on the lines, but I'll open up an opportunity for you to shoot me a question now.
Can I ask a question?
Fire away.
From the point of view of a consumer or an investor, why do we want any inflation at all?
Well, that's a great question. Generally, inflation's there and it follows a strong economy, and it's a way of keeping an economy tame. So if we didn't have inflation, it would allow for the stock market to literally run out of valuations, to run away from us. And at some point, would it make sense for you to follow that momentum. And so really inflation is just kind of a reality check to the markets, to prices, things like that. But generally, inflation, it's following a strong economy, which we all want. It's interesting you bring that topic up. So speaking to yields, and I didn't mention this, but the 10-year Treasury, obviously we were at a low on the Treasury, a low point this year, and we hit a high point of almost 1.8%. At both periods of time, the stock market hit an all-time high, which doesn't normally or almost never happens that way. When you see the 10-year Treasury and yields move up, it's inflationary. Investors are looking at that as well. Well, from a company standpoint, growth companies struggle during periods of inflation or high interest periods because they're highly leveraged. Their growth comes from a lot of debt for them to grow. It's more expensive for them to grow that way. On the flip side, when it's very low, growth companies do really well. And that's probably why we've seen a little bit of almost a flip-flop between value and growth right now. Yields, the interest rates have come down tremendously off of where they were in March, and that gives investors a little bit more faith in that growth investment. Got a question from the chat. Just kind of one thing I didn't talk about is international side. So I talked largely about the U.S. economy here. So thanks for raising the point on the international market outlook. You know, the S&P 500, the U.S. domestic has led globally for year to date, really for the last, 5, 6, 7 years. There's been 1 year where international did really well. International economies really were hit pretty hard, obviously, with COVID. They don't have necessarily maybe the financial means like more mature economies like the United States or Europe does to combat these pandemics. And a lot of those economies actually are our supply chain. For instance, China. It's an emerging market. Most people don't realize that because they think of China. It's got 1.5 billion people. Their capital market is pretty well distinguished, but they're actually still an emerging capital market. They were first hit, obviously, by the pandemic. They managed their way through it fairly well. So the first round, going back 18 months ago, a lot of those international companies or countries managed COVID better than the United States. This time around, the United States is actually managing the Delta variant much better than a lot of the other countries have. China was hit hard by it again, and it's hurting the supply chain for a lot of U.S. companies. That said, the emerging markets has performed pretty poorly this year, and it's just driven by COVID and shutdowns, not being able to produce the manufacturing. China is the world's largest exporter. So China's been hit very hard. More developed countries, Australia, Europe, they're doing fairly well. Their performance, they're up 11, 12% if you're looking at that international developed performance, but they're still, well behind the U.S. economy. And we've been saying this for a long time. At some point, the international economies will take over and perform better than the U.S. stock market. And a lot of that's because just going back from the financial crisis, 08, 09, international countries, they were well behind us in that recovery. Their economies were still way behind. There's tremendous value in companies overseas, more so than there are here in our own domestic U.S. But for right now, it's still a struggle. We're not exiting out of international. We're not participating in international for investments. We want to be there. And largely it comes down to that diversification. We just don't know when that flip will happen, that switch will change, and it really takes off and rallies. In our portfolios, I'm just going to use an example, 70% equity portfolio, you're going to see roughly 20% of that portfolio in international. So while it's a significant weighting, you can still see our bias is still greatly to the United States. And hopefully I'm answering your question there, Matt. Anyone else have any questions out there via chat or the phone? Well, I certainly thank you for everyone's participation today, coming onto the call. Sorry that there was a little bit of a couple months in between the last Bright Ideas. I think I did the last one in April, May. The summer was kind of crazy, let it get away from me. But hope to do another one probably in October-ish, I'm guessing, is probably when our next Bright Ideas will be, barring any natural disaster. That makes me want to get out in front of you guys and assure you that we're doing all the right things. Again, if you should continue to have any questions following today, you can always email us at wmtquestions@syb.com. I'm happy to take questions off to the side. And hopefully, your advisor will be reaching out if you haven't had a recent meeting and talking through and scheduling a meeting and be able to get through things here in the coming months. Otherwise, hope everyone has a great Labor Day weekend. We appreciate you being a partner of ours. And stay safe and stay healthy. Take care, everybody.